All right, let's see. Okay, mic is on. All right, guys, good afternoon. Welcome to the aftermarket recap. It is 5:01 Eastern Standard Time. My name is Carlos Garcia, founder and CEO of G.A.R Capital. Thank you so much for joining me today and every afternoon at this time. Before we begin, bottom right-hand corner of your screen, little white logo, click on that, turn on notifications, subscribe to our channel. Like our videos, really does help the algorithm here on YouTube. The more likes you give us, I guess we get brownie points, who knows. But there you go. So let's talk about the market today. It was an ugly one today, but we're going to put things in context, keep things the way they are in terms of, let's see, next opportunities, what's the next move. Dow Jones down 392 points today, down 1%. The Nasdaq fell 3.34%, 15,100, 4,700 for the S&P. Just felt like just yesterday we were at 4,800. The VIX spiked today, up 16.68% at 1973. The equal weight RSP, which is the S&P 500 equal weight ETF, down 1.5%, 1.54, 161.67. Small caps were crushed today, down about 3.39% on IWM 217.36. Gold, you would think, even with all this volatility, gold would be higher. It didn't. It was down 0.30% on the GLD. Yield spiked above 1.705% on the 10-year. The dollar index fell about 1.1% at 96.16. Let's take a look at the credit markets. High yield credit took a hit, down 0.77%, 86.08. Investment grade credit fell 0.59%, 130.45. When I say credit, I'm talking about bonds. Remember that. Take a look quickly on futures. Russell futures down 3.4%. Nasdaq futures down 3.2%. Those are the big ones that stood out. Obviously, E-mini futures down 1.93%. Crude oil did gain a little bit, 0.26%, 77.19 a barrel. Gold futures right still above that 1800 level. Remember we put that in the morning when we're talking about the alerts. The alert didn't break, so again we didn't get into that. But gold down 0.22%. Silver futures down 1% this session in the futures, 22.82. Taking a look at crypto. Crypto took a hit today, down 7.33%, 35.44 on Ethereum. For futures, 43,515 for Bitcoin, down 6%. And gasoline futures fell slightly, so at least something. Down $2.27 right now. All right, let's take a look at crypto this afternoon. Again, it's all red, but we're going to go over it together. I usually show you my crypto portfolio, so I'll show it to you as well. Today, Bitcoin was down 5.6%, 43,644 on the spot. Ethereum 35.57, down 6.77%. Solana down about 9.29%, 153.24. Cardano down about 6%, 124.24. Ripple 79 cents, down 4.5%. Terra down 9%. Polkadot down about 9.8. You're starting to notice the pattern. Pretty down day for the most part in crypto, but if you're a crypto investor, you're pretty much used to it. Let's take a look here on my crypto portfolio. Down today about 6%. That's about a $10,806 hit in terms of paper. But yeah, so am I panicking? I haven't sold anything. All I've done was I bought some Ethereum today and I bought some Bitcoin today. Not tons of money, 50 bucks a pop. You can see it here, but I have that every week. So again, little bites add up. Got a good price, I guess, and relatively speaking. So again, nothing has really changed on my mindset with crypto at all. So either way. Okay, so let's take a look at the S&P heat map. First, let's go with groups. Here, let's see what worked, what didn't work. Consumer defensive, materials, energy, utilities, down less than 1%, the best of the worst. And then technology, the big hit, down 3.68%. Communication services down 3.41%. Real estate down 2.88%. Cyclicals down 2.87%. Let's go and take a look at the maps. What was the big loser today? You can see Google was down 4.5%. Microsoft down 3.8%. Apple down 2.66%. AT&T, Verizon, T-Mobile, all gains today. Walmart, 1.35%, the consumer defensives. Costco, down 2.5% today. Costco, Coca-Cola, PepsiCo did gain today marginally. Intel, the only one out of the chip makers that actually gained, up 1.37%. Berkshire Hathaway up 0.45%. Tesla down 5.35%. The worst among the big mega cap names. If you want to include NVIDIA in there, NVIDIA did worse, down 5.76%. Adobe on that downgrade earlier today just accelerated down 7.14%. Really the only green you see here, healthcare, some consumer defensives, telecoms. What do the telecoms have in common? High dividends. So again, this is where the value companies do better. We talked about that. Industrials, kind of mixed, but not as bad as tech, obviously. Again, we talked in a rising rate environment, industrials, energy, financials are going to do well. Now, granted, financials were down today too. And that's where we were. So let's take a look here at why the things happened the way they did today. So we had a really nice ADP private payroll report, but here's a couple of headlines in terms of the Federal Reserve. This is from the Wall Street Journal. Federal Reserve officials signaled greater discomfort with high inflation. Oops, why did it do that? Let me press spacebar on my keyboard, my apologies. Let me reread the headline. Had it here. I had it here on it. Okay, here we go. Federal Reserve officials signaled greater discomfort with high inflation at their meeting last month. This is the Fed meeting minutes. It wasn't a Fed meeting. It wasn't FOMC. This is just the meeting minutes, what they talked about when they came to their rate decision. That's what Fed meetings minutes are, where they eyed a faster timetable for raising interest rates this year. So we already kind of priced in, I think, maybe 1 or 2 interest rates. Now it's the acceleration. This is what causes these kind of issues, is where it's accelerated, where we're getting rate hikes quicker than we expected, but we know rate hikes are coming anyways. But we talked about that in the morning, that if we get lockdowns or Omicron or whatever like that getting worse, then more than likely the Fed could pause, but we're not there yet. So you can kind of look at it 2 ways. Hey, I guess the Fed sees the economy is healthy, then they're going to raise rates, to tame inflation. They've done all they can. Or you have the Omicron coronavirus issue where it's kind of pulling like, no, we're not out of the woods yet. Oh, yes, we are. Oh, no, we're not. So it's kind of like the market seeking direction in that term. That's the best analogy I can tell you. Here's from Bloomberg. This is what happened to the Nasdaq in sense. Quote, participants generally notice that given their individual outlooks for the economy, the labor market, and inflation, it may become warranted to increase the federal funds rate sooner rather than later, sooner or at a faster pace that participants had earlier anticipated. So again, the rate hikes coming in faster, being discussed, is what spooked growth names. Hold that thought. According to the December 14-15 meeting of the U.S. Central Bank's policy setting Federal Open Market Committee published on Wednesday. So we know we were going to raise rates anyways. We knew that. We knew that was going to happen in 2022. I don't think that's any surprising to anybody. The problem is now it's going to be sooner. Now we have a meeting in March. More than likely, that could happen. We could raise rates. Now, are we going to get a 50 basis point increase? No. More than likely, it's going to be gradual, maybe 25 basis increase. So what does that mean? Does that mean the world's over? No. The issue is when you have a lot of growth companies, again, they need low rates in order to grow, in order to borrow money cheaply. If we ended up going up 25 basis points, do you think that really hurts the bottom line for a lot of these companies, even 20, 30, 40, 50% of its value? Take a look at ARKK. Or is it, in your opinion, oversold? Do you think that a 25 basis increase, let's say we have 3 rate increases this year, 25 basis points a pop, 0.25%, that's 75 basis points. Do you think 0.75% in interest rate hikes will equal to having growth companies, let's say, for example, Palantir, we use them as an example. Do you think that makes them 50% less valuable? I think it's a little overdone, which is okay, and I understand. What we have here is a de-risking in terms of growth, taking out those names that have done well the past 5 years, 4 years, 3 years, and putting into something value stocks that pay dividends because they do better in a raising rate environment. This is why I included Goldman Sachs in the top 10. This is why I included Caterpillar in the top 10. These are value companies that generate good liquidity, good cash, and they return to shareholders. So again, what can beat inflation in a sense? Well, getting cash return from your company that you own. So again, that's not just looking at a company based on valuation. Again, valuation meaning that, hey, I bought it at 20, I sold it at 30. But you have a company that's a value company that doesn't have many growth prospects at the end of the day. Doesn't have the growth prospects of, say, an Apple, as an example, or a Salesforce.com. Caterpillar isn't in that category. Goldman Sachs is not in that category. PepsiCo is not in that category. They've already hit kind of the sense of the peak growth, the much that they're going to get. They're not a growth company anymore. They're more of a value company, meaning that they make money, they return it to the shareholders. That's what keeps people invested because it's just not going to move. The problem that we have now, and I think a lot of what I've noticed in terms of the stock market, social media and everything, I think what you have is that you've had so much money, so much capital chasing these high speculative names. Now, don't get me wrong. I own some speculative names, and I was telling that to Investment Club. They're not the core holdings of my portfolio. They're not. Again, the biggest part of my portfolio really is SpyG. SpyG and Apple are really like the biggest parts of my portfolio. Now, Apple is my only IRA. It's the only stock in my IRA, and I love that company. Their growth, yes. They pay a dividend, yes. But look how their balance sheet is. Balance sheet is on fire. They're great. So I don't consider them, in a sense, speculative at all. But again, I think a lot of people really chased, the Zooms of the world, the Pelotons of the world, the Pinterests of the world, the Nicolas of the world, chasing that, in a sense, the Airbnbs. I own Airbnb, or chasing Snap, BlackBerry, SoFi, those names. Now, again, I own names like Penn. I own names like Coin. But again, they're a small slice of allocation of my portfolio. I may have in my portfolio maybe about 15 growth companies. Now, they don't take a big part, but again, I'm okay with owning them because I don't need them to perform right away. Again, they're more disruptors in their industry. I'm looking forward. Granted, in 2003, Google had their IPO at $85 a share. Now, granted, back then, it was really just a search engine back then. They didn't have YouTube yet. They didn't have all the great things that they have now. In my opinion, that was a growth speculative name. Now, again, after the 2000 dot-com bubble, a lot of people were nervous about these speculative names, but yet people that believed in an Amazon, that believed in a Google, they grew, and they did a Facebook when it first IPO'd. They believed in that. Hey, there's a lot of speculative crap out there. Don't get me wrong, there is, and you just have to be careful and be very vigilant in what you're investing in. But there is winners there down the line. I think what we are now is at a point of we need instant gratification so we can just show like, hey, listen, I'm a great investor. Really, the best investors are patient. So again, if you own any of these names, this thing that really changes sentiment pretty quickly is price. Price is the big sentiment changer. But let's say, for example, you had a car like a Escalade, say Cadillac Escalade. I don't know how much they run for, $100,000, whatever. And GM, the dealer, called you and said, we have a 30% off deal. Would you go buy that car? Probably. I would say most people would probably do that because very rarely do you see cars 30% off for the most part. But the thing is that with the car, you see the underlying value. The value is take you to point A to point B, you drive in comfort, has air conditioning, all the bells and whistles, right? With the stock, it's a little different because we can't touch it. We can only see it on a screen. So I think it kind of gives away that sensory input. For example, a lot of real estate people, they like real estate because they can touch their asset, or gold investors, they can hold their asset. But crypto and stocks is a whole different ballgame because it's electronic. So you don't have that automatic sensory, kind of gratification the way you do with a property or an automobile or collectibles or memorabilia, for example, or even just good old-fashioned cash. So I think what we have is a lot of people that are in these speculative names a little too heavy. Again, you're talking about the stock market is really 100 points from all-time highs. And you would have thought the world ended today. Yes, the Nasdaq was down 3%. We're going to go over the technicals here in a second. I know I'm running too long, but I will answer your questions, I promise. But again, I really wanted to give you that point that, again, the kind of mania, the speculation you get, yes, some of these valuations are very high. And when you have rising rates, these valuations, they don't make sense anymore. So what the Fed is trying to do to curb inflation is really just raise rates. Keep in mind, the last few bull markets we had, the interest rates were at 3-4%. The prime rate. It wasn't at zero all the time. That didn't happen. So again, remember how many rate hikes we had during President Trump's tenure. But again, before that, George W. Bush's tenure, when the stock market was doing well, we had rate hikes to curb inflation. That's fair. So again, the understanding is always, as an investor, build your investment portfolio with an index fund first as your foundation. Then you do your core holdings, which is the companies that you consume. For example, if you're a Nike investor today, you're pretty much not freaking out. If you are a Nike investor today, you're not freaking out for the most part. If you're an Amazon investor, you're not freaking out. But if you were a space investor, Virgin Galactic, yeah, you needed some Imodium for all the roller coaster ride. But at the end of the day, high risk, high reward, that's the deal. That's usually the deal. So again, if you really want the good gains, you're gonna have to stomach some pain. Good gain, stomach some pain. That actually rhymes, which is actually pretty good. So let's take a look at some technicals before we answer some questions. Let's take a look at E-mini futures. I put everything on the daily to make life easy. So you can see E-mini futures has not even tapped the 50-day moving average. But what we have done is pretty much wipe out almost the Santa rally. The Santa rally officially, I guess I would officially call it the 21st of December. So we haven't even wiped that out yet. So even if we retested, that's 45.62. That's about 130 points. If you expect that rally to dissipate and go away, then that's your target. If you expect the 50-day moving average to bounce us, then you're looking at around 466 on SPY, 467 on SPY to be your support. Because I know people ask me about SPY. Your real big support on E-mini futures, if you're looking at home, the S&P 500, 45.52 is your 100-day moving average. Again, we'll stretch it out, and you can see that has been the consistent bounce level. And what's great about trading is that you can take advantage of both feelings in the market. Whether it's euphoria, we're at all-time highs and everyone's going long, you could be contrarian and go short. And you think right now the world's ending, you can be a contrarian and buy long. So again, I'm waiting for that 50-day moving average. Let's see if it holds. If it doesn't, then more likely it's the 100-day moving average. Let's see what we get. But if it breaks the 50, definitely puts could be in play. Again, not a huge deal. Does it mean the world's over? Does it mean the year's over? No, it's the first big pullback of 2022. And I will say this, it will not be the last one. So there you go. All right, let's answer some questions here today. I know there's tons of stuff. Carmen, all right, thoughts on faster taper in your outlook? Think we go down from here, less bullish on tech? So again, what you have here, we had a Santa rally that's in the Nasdaq that's almost wiped out, but in the S&P it has not. So more than likely we're just going to retest the breakout, which has happened for the past, I would say, 4 or 5 weeks. So you can see since 16,767 on the Nasdaq and the future side, you can see basically we've just been channeling for the most part. We've just been ranging, really ranging about, I don't know, not even 100 points. So is that the end of the world? Not really. I actually, is it 100 points? Yeah, about 1,000 points on the Nasdaq. So again, big level, obviously, big numbers. But at the end of the day, there is opportunity out there. But again, the first ones to get sold will be those high-flying names because a lot of these hedge funds can't really hold on to them. Unless you're ARKK, then I don't know. That's really up to her or Kathy. Kathy Wood. I have ARKK, so I'm okay with buying the dip on that. I actually bought some stocks today, so I'm cool with it. But again, I'm willing to hold long term. It's very hard, especially now, and as a fund manager, let's just say, to really kind of hold on and say, hey, listen, just be patient, because most people aren't. They just aren't at the end of the day. And investors have their prerogative. They have their targets. So again, I always say, index fund makes life easy. And then after that, go ahead and stick with names that you know and love. But in terms of the taper, it's more of the interest rate rising and the speed of it, the velocity of how fast you're going to do it. Having rates being raised is not news to us. We knew that. We didn't know when. Now they're talking possibly March. Speed, that's the assumption, being quicker. Again, if you notice, the Fed really talks a lot of vagueness, which is very frustrating as a trader. But all you can do is trade what's in front of you at the end of the day. So I don't think the Fed really cares about my personal prediction. But again, that 50-day moving average tells a lot. That 100-day moving average tells me a lot. A lot of it is really just technical analysis on where we are, honestly. What is the price for Upstart and long-term SoFi? Let's take a look at SoFi first. All right, so SoFi, I think $12.03 is a good level. Obviously, I mean, you're getting things at a deep discount here, which is nice. So $12.03 would basically retake that initial upside break from last year. That tells you a lot. December of 2020. That says a lot. So again, that'd be one. The second one you had was Upstart. And Upstart, your next level, I'd have to put it here, is right around $80.99. And again, I own some Upstart. So again, $80.99 would be great. Again, it's not like I'm going to sell it or anything like that. Again, I'm willing to hold it long term because it's part of my speculation bucket. It's not my whole portfolio. It's very important, guys, that I understand if you're freaking about these names out. God, I hold Palantir, I own Blink. If that's the biggest part of your portfolio, yes, you're freaking out. But if you are well balanced and you have an index fund, you're 1% off all-time highs. Literally 1.5% from all-time highs. I mean, I don't think you'd be freaking out if you had your foundation first. How was the options trading today? It was pretty ugly. We did catch Boeing in the morning. That was good. But after that, it was just a bloodbath for the most part. And all the move was done at 2. And after that, it was just wobbling for the most part. PFE upgraded 70. Today's closing price 56.6. Yep, I saw that. PFE was upgraded. Walmart 145 calls came back for me. Nice, very nice. Comcast hella green. Yep, Comcast again. They pay dividend too. Do you hold any fixed income bonds on this? Yes, I do have some bond funds with my dividend portfolio. How's Apple looking after the minutes? Apple is down, obviously. Apple is what we call low beta, meaning it moves with the market. It was down 2.66%. The S&P down about 2%. Sounds about right, since it's the biggest part of the S&P when it's weighted, not when it's not weighted stocks. Let me see. Excuse me. When it's weighted. How many stocks or ETFs do you think is a good number for long-term portfolio? That really depends. Again, I'd rather you focus on quality names that you consume after you do the index fund. So you have the index fund, and then it's your core holdings. The companies that you actually do business with, not that my friend told me was cool, and oh, look at the numbers they did before. Where do you buy coffee? What car do you drive? What clothes do you shop? What shoes do you wear? Stuff that you consume makes it a lot easier to handle the swings that everyone's going through right now. What do you think is more likely for Amazon in 2022? Stock split or they're paying dividend? Stock split. I would say that's more likely. And it's funny because Amazon is not a growth company. I guess they think so, but in their mind, remember, paying a dividend is not a requirement. That's up to them. So again, for them, they think that our capital is better off investing it in our own company. And the investors of Amazon look at that and say, me being one of them, we trust you to do the right thing because Amazon's been on fire. Okay, so instead of you paying me, invest in the company so the stock can come up. That's basically what you're doing. You're creating something called value generation on the companies. Now, a lot of companies I remember would actually use excess money to buy back shares and artificially profit. IBM being the first one to mind. We know Apple buys back shares. We know Google buys back shares. We know Facebook buys back shares. So it's nothing new. A lot of these tech companies have so much cash, they need to deploy it somewhere. Preaching knowledge right now. Portfolio allocation, understanding what you own is key. Keep grinding. Thanks for the prayer updates. Thank you, Chris. Absolutely. I think if there's one thing that I really like to hit home is that investing, it's not that it's stressful. It's time consuming. You have to do the homework. So again, it's super easy to do it if you just do the index fund first. But a lot of people were so now consumed with the Reddits and the Wall Street bets, it's turned into a casino. And I'm not saying that you shouldn't dabble in some speculative names. Hey man, I have cannabis stocks. That's fine. But again, to me, that's what I want to invest in. But again, everyone has different risk allocations. So again, if you're in your 20s and you have these speculative stocks, I wouldn't even worry. That's fine. I mean, dude, you have your whole life to make more money. That makes sense. And I'd rather someone be invested and actually care about the companies they own than not give a shit and not invest at all. I think a bad investor is better than one who doesn't invest at all, 100%. Because you know what? Even if you're a bad stock investor, at the end of the day, eventually you'll get something right. It'd be difficult to get it wrong all the time. I mean, you really can't go wrong with an Apple. You really can't go wrong with a JPM. You really can't go wrong with an Amazon or a Google or a Procter & Gamble or a Johnson & Johnson. You're not going to lose every dollar you own if you put everything in Johnson & Johnson. That I guarantee you. You're never going to lose all of your money. So again, what you have is that now you have some new members in the arena that look at these speculative numbers and they try to chase. This is nothing new from the 80s and the 70s where investors would chase yield. We used to call that the dividend yield trap, where, oh, but they pay 17% or 16% dividend. Yeah, man, that's more likely not going to hold up. That's why AT&T, I don't want to invest in AT&T. I used to be a shareholder of them, but I'm not anymore. 9% yield? First of all, if they paid 9% yield, I'd be extremely concerned as a shareholder. Why are you paying this much out when you can literally borrow super cheap? Like you can borrow, your investment grade company that can borrow for like 2%, 3%. Why are you paying out 9% interest rate? Because you want to keep the yield intact. That's not a smart deployment of capital. That tells me that this company has really no plan for any kind of growth or paying down debt, and AT&T is in debt. So let's pay shareholders 9% while we don't service our own debt. Even though they do service their debt, but they can use that money to pay down debt or to strengthen the balance sheet a little more, in my opinion. But again, I don't run AT&T. Again, I just have my cell phone service with them. Hope that makes sense. Oh yeah, definitely. Google sliced with 100 DMA on the high volume. Safe to assume more downside coming. Well, again, Google runs very close to the Nasdaq. So we'll take a look at Google, and you can see here that 2,700. Looking for that one first. I've been waiting to buy Google for a while now, and trust me, it took everything out of me not to buy it at 3,000. I was like, no, I can wait a little bit. Patience pays. Even when the market is red, guys, that's opportunity for those who want to go a little shopping. You don't have to buy every dip. Not every dip is equal. Remember that. Not every dip is equal. So again, me being greedy, I would love Apple to fall 20% tomorrow on a flash crash and bounce back up, and I could scoop up a ton of shares. I would love that, but that's probably not going to happen. Google falling 4.68% on a day with no earnings or any big news, that's not usual. Google doesn't fall like that. But look at the daily and look at the Nasdaq. Runs pretty similar. When you think Google's a big part of the Nasdaq, so this is why they run together. The issue with futures now is that we've commoditized stocks. Now, Google is not a living, breathing company with a great balance sheet, great management, and growth prospects. They're just a cog in the big wheel that is the futures. So the futures market, in a sense, has really kind of changed the game in the sense of the stock market. We don't look at stocks the same. We don't see Google, again, like as a living, breathing company. We see Google as part of the wheel. Apple's part of the wheel. Microsoft's part of the wheel. Microsoft didn't do anything wrong today. Microsoft still makes money. Apple still makes money. Nothing has changed. But did their value really fall $30 billion today because the Nasdaq fell? Because rates went up? No, what you have is that you have instant moves to the downside and slowly creeping up. So remember, escalator up, elevator down, nothing has changed. Guys, if you survived 2020 and that stock market, this is nothing to you. This is just another day in the office because it's happened. And what happens? We end up coming out green on the other side. So it's back and forth. Oh, it's always the Fed, it's always coronavirus, it's always a debt ceiling, it's always elections, it's always a new Fed chairman, it's always something. It's always something. Pick your reason. And what happens at the end of the day? We end up going up again. And so I apologize if I'm just like back and forth with it because I've heard it so many times. It's always something. Oh, nuclear weapons in North Korea was a good one. I remember trading through that shit. So there you go. What do you think about SE stocks? I don't know what SE is. Is that Seagate? I believe Seagate had a stock offering, so hence the stock went down, obviously diluting current shareholders. There's a lot of downside to this one. I don't know much about them. But if you do and you like the price here, go for it. If you don't, wait a little bit. That's fine. If you want to own it. I don't know much about them, so I can't really say, oh yeah, I like them, because I don't know. Let's see. High dividend yield unsustainable says they don't have opportunities to invest cash for us. You got it. JD Fields basically just reiterate what I said. It's basically telling me that you have nothing better to do with your cash and your stock price is falling. Why wouldn't AT&T say, let's cut the dividend in half, take that cash and buy back stock, showing us, the investors, hey, you guys really, really believe in the company. You really believe in the growth prospects or invest in something. Again, a lot of ways to deploy capital if you're a corporation. You could always do M&A, mergers and acquisitions. You could do stock buybacks. You could do a special dividend if you wanted. You could pay down debt, or you can just keep the cash forward and see from how it goes from there. Granted, you have the very extremes of these. You have the Berkshire Hathaway, Warren Buffett type, who has so much cash sitting there, but guess what? Inflation is running hot, so what's to happen with that cash? It gets eaten alive. So where do you put it? Where do you put it? Oh my God, do I buy this? Do I buy that? He hasn't done much. But yet the stock market keeps going higher. And then it kills him because he's like, damn, I could have deployed capital. But again, Warren Buffett is on a different level from everyone else. Keep in mind, he's in his 80s. So speculation is not his thing, obviously. We know that. He caters to a certain type of investor. The Benjamin Graham intelligent investor, value investor. Does that mean you? Man, there's a lot of great hedge fund managers that don't do the stuff that Warren Buffett does. Bill Ackman being one, Paul Tudor Jones being another, tons of them. So again, I don't think you should put yourself in that little peg of, well, Warren says this and do that. You should make decisions on your investment and your money the way you feel most comfortable with. You should do the test tonight. Again, we had a nice red day today. Bad red day. Pretty red. Not the worst I've ever seen, obviously. If you are asleep, if you're at night, staying up at night, looking at your portfolio, worrying, you need to sell the stocks that worry you the most. it's just not worth it. It just isn't. Your headspace is too important as an investor because it's all between the ears, guys. How you see things, how you perceive things. The great thing about the market is that we don't all see the same thing. We all see something differently. So that really helps in the market making scheme, in the market making way, because you're always gonna have a seller and you're always gonna have a buyer. So again, you need to decide, hey man, what works for me? What's best for me? I don't like this stock. I like this one. I don't want to own this anymore. That is okay. You do not need a reason to sell. You do not need a reason to buy. That is your money. You are the hedge fund manager of your assets and your wealth. What do you think about PayPal too? Let's take a look. Last one before I roll. PayPal, I have an alert at 153.16. I had to expand that a little more. And you can see 153.16 is all the way down here. It looks like it might have hit support on PayPal. But again, a lot of the growth, high flying, high beta names, PayPal being a high beta name. Now, I wouldn't say much speculative, but high beta, they're going to take a hit. So again, what you have a lot here is a lot of de-risking. A lot of de-risking ahead of interest rates. More times than not, it's too much de-risking. It's too much off the table. It's done too quickly. And most times they regret it. It just happens that way. But that's what I've seen all the time. All right, guys, we'll leave it there. It was a great live. I know I had a lot to say. My apologies, but I really like to take the opportunity, especially on red days, to kind of reiterate a lot of the same principles that I use personally. You don't have to do everything I say. Trust me, you don't. But again, maybe these words of encouragement or kind of perspective does make a difference. Guys, what you're doing every day, watching these videos, seeing what we talk about, it is not easy. Let me make that clear. It is very difficult. They do not teach this in school. So it's really, you're just kind of learning on your own. No one's putting a gun to your head to listen to this or to do this. Again, you're doing this because you want to. You want to learn. You want to expand your knowledge. That's the best part. And think of it as an investment in yourself. So again, at the end of the day, guys, be kind to yourself. Take it easy. One red day does not make a market. One bad day does not make a year. Take it easy. We have seen these many times. And what do I always say? Stay bullish. And what always happens? New all-time high. And then I always get the comments that we're going to fall. And I say, when are we going to fall? He's like, I don't know, soon. And I go, yeah, always soon. Always. I've been hearing that, guys. I've been hearing it since the inception of this company in 2014. Really, the end of the world pretty much almost happened in 2020. And we bounced back from it. So what does that tell you? The world's not ending. Everything's going to be okay. Have a great rest of your day, guys. We'll leave it there. We'll catch you tomorrow for the morning note. Cheers, guys.